Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Welcome back to our special live coverage of the Milken Global Institute Conference in Beverly Hills, California. I'm Romaine Bostick alongside Carol Massar. A big focus today, not just on the broader investment space, but really on direct lending and alternative credit. And one of the specialists in that space, Ares Management, still seeing opportunities out there. That includes, well, even helping buyout shops shore up the companies they back against higher interest rates, while at the same time providing cash back to fund investors without necessarily having to sell those underlying assets. I'm pleased to say that the head of Ares Credit Group is joining us right now. Kipp, DeVeer, live here on the Milken stage. Kipp, great to see you.
Thanks for having me.
Where are you finding opportunities right now?
So we're actually finding a pretty good constructive backdrop for everything that we do. Just as a reminder, credit, real estate, private equity, secondaries, and we play in a host of different geographies. Obviously, our largest business in the U.S., but we're in Europe and we're in Asia as well. So I think my quick takeaway is we're actually seeing the economy better than we might have expected at this point.
U.S. economy? U.S. economy or everything?
I think the global economy is saved for a few, but the U.S. economy in particular, for sure. We've been questioning a little bit, isn't transaction activity down a lot? And then when we go back and look at the deployment that we've had in our businesses, it would actually tell you that we're doing fine. To me, that means we're picking up market share and just continuing to be more and more relevant in all the businesses that we're in.
With some of those transactions, are we primarily talking about kind of mid-tier, middle market type companies or something bigger?
Yeah, I mean, we have a pretty broad credit business. So today it's about $300 billion of assets in 5 different businesses. I mean, it ranges from the lower middle market, which can be probably as small as 20 million of EBITDA, but increasingly we're able to finance these much larger companies that you all are writing about at Bloomberg. So, multi-billion dollar deals as well.
What are those deals looking like? And I'm curious, in a higher rate environment, how that kind of impacts the financial structure a little bit.
Sorry, it's so loud in here. Can you say that again?
So what's kind of, in terms of a higher rate environment, how is it impacting a little bit the financial structure of the deals? It is really loud.
I think, look, the good news is a higher rate environment means that assets are worth less. And that's true real estate, corporates, et cetera. So you're starting to see a reduction, I'd say, in purchase prices on corporate assets and certainly on real estate. And of course, with higher rates, that helps because you don't need to set these companies up with as much debt.
What kind of deals are getting done in real estate in particular? I think we've had a couple of conversations on the residential side of things, also on global properties in general and office as well. So what kind of deals are happening? Are you finding of interest in real estate?
My day-to-day is not, frankly, living in the real estate business, but I think if we surveyed everybody in real estate at Ares, it's really important that you don't take too broad a brush on real estate, right? So office is very, very different than we think industrial and multifamily, or most of our portfolios are, both on the lending side and on the equity side. I think office is tougher, and it's a bit of a we'll see. Although, we're all in New York. You've probably read the articles. The A properties in New York are fully leased up, and the B properties are not. So I think it's just, you really have to be a good asset selector and a good lender going in and doing the fundamental work, depending on the asset class and depending on
really
the
know it, yeah.
Well, with some of the strength we are seeing in the economy, and more importantly, some of the stability we're finally seeing in the rate environment.
Yep.
I mean, and this goes beyond just real estate. Overall, is that helping facilitate more transactions?
There are all sorts of, and we talked about this on our earnings call last week, there are all sorts of contributors that should lead to increased deal activity. So we think plateauing, of rates, or the lack of continued rise of rates is one. We've talked about this a lot publicly, that most investors, our LPs, are really have significant appetite to get capital back.
Yeah.
And there's a lot of money in the ground in leveraged finance space and in private equity and elsewhere that's going to need to compel transaction opportunities. The economic backdrop being good, obviously, is one of those as well.
What does fundraising look like for you right now? Is that more difficult?
I shouldn't really talk about it in any specificity, but we mentioned this on the earnings call last week. We raised $17 billion of capital last quarter at Ares, and about $14 billion of that was in credit. So the good news is, in a lot of the places where we live, it has not been any harder. I think there's a real change in the way that investors have approached their portfolios, public versus private, liquid versus illiquid, et cetera, and that's continuing to create tailwinds for us.
You know, Kipp, $14 billion on the credit side, that's a nice little bucket, if you will, to put to work, right? $14 billion. How quickly do you think you put that to work in this environment, or how quickly do you want to?
I mean, we try to be thoughtful, obviously, as we raise capital, and the way that we justify capital raises with our investors is certainly with our belief, and we think their belief that we can obviously deploy along with what we've raised in terms of the capital. So I think if new deal activity really does pick up a bit, it'll be even easier. But we've been hitting our deployment targets, as I mentioned earlier, regardless. So we wouldn't be raising the capital if we didn't think that we could deploy it over a reasonable period of time. That being said, having dry powder is really nice as the markets are always transitioning.
Kipp, what are investor expectations? I talked a little bit about the higher rate environment. In an environment where you can get about 5% on a 10-year, you know, it's just like, I think the rethink about expectations of what investors want longer term.
Oh, look, I mean, the reality is in a lot of the businesses that we're in a spread product. So we need to provide, you know, attractive risk reward relative to the risk-free rate, and that's how we think about things. So there's no doubt, and base rates going up has helped because a lot of what we do is floating rate assets. But the private markets in particular have to shift with the risk-free rate and with the public markets.
I want to talk about Ares as a business. You guys have been expanding into Asia. You have a new wealth management offering here. First, talk about Asia and the opportunities there. Is that where most of the growth is going to be? Do you think so?
Well, I mean, we have some really well-established platforms in Asia. It obviously represents a tremendously large market, but I'd say in our businesses, it's probably less sophisticated than certainly what we have here in the US and also in Europe. So I just view it as earlier stage. There we basically have a credit business that does performing credit and also special situations, and we recently acquired a private equity manager based in Singapore there that I think should provide growth. I think in Asia we're focused on other areas, whether it's real estate, infrastructure, and real assets as we try to grow into a larger footprint there.
But, you know, it's interesting. We bring up Asia, and, you know, obviously you go back a few years, and I feel like we always talked about China, but Japan is all of a sudden, especially here at Milken, we're hearing many investors bring up the Japanese market, the opportunity that it presents for you guys specifically in the area of credit.
Yeah, I mean, we think, look, the reality is it's an enormous economy with a very sophisticated business community that is massively underallocated relative to the rest of the world in terms of alternatives. And the reason for that is obviously just the required rate of return that they need over there has historically been lower, based on the way that their economy works. That's probably changing, but I think they're also getting more sophisticated and frankly more interested about wanting to really roll up their sleeves, do the work, and get invested in alternatives. And when you talk about a 1% shift in the portfolios over there from traditional to alternatives, the numbers get very large very quickly.
Yeah, what is the differential right now in terms of the allocations that you see to alternatives in the U.S. versus, say, in Asia, particularly Japan, or even in Europe?
Yeah, I mean, I think it depends who you are, whether you're, you know, a pension versus a sovereign and an endowment, which will typically have a much longer range and then much higher allocation to alternatives. The allocation in Japan today is virtually zero.
Yeah. What about how you're structuring deals right now? There's been a lot of discussion about how alternative asset managers, private credit funds are partnering with a lot of the bigger money center banks, the more traditional banks, to get deals done. I mean, they're basically calling you, and not necessarily you going to them. Is this going to be kind of the structure of deals for the foreseeable future? I
mean, I think because on the new transaction front, we're a natural partner for banks. We obviously buy loans and buy high yield and syndicated transactions from banks in the regular way. We're also a good junior capital provider, which is a business that they have had less and less interest in over the years. But I do think over the next couple of years, banks will keep rationalizing the types of businesses that they're in. and we'll probably sell a portion of this business or that business. We think we can be very good buyers of those businesses.
Private credit, is it getting crowded at all? It feels like everybody, even this week alone, we're like different tie-ups and link-ups, if you will, between traditional finance and some of the private players.
I've been doing this for 20 plus years, so the market has just grown substantially, right? So when we started, we talked about financing $10 to $50 million EBITDA businesses. As I mentioned to you earlier, we can now talk to much, much larger companies because of our capital base. We think it's a business that actually gets easier as you get larger, i.e. there are real scale advantages. So is it more crowded? Is it more discussed? It is. But when you look at the risk reward and you look at the results that we're generating for investors, I think they're still pretty compelling.
What can you give us in terms of insight about returns to investors? Returns to investors.
Very little.
Come on.
Are they being more demanding, though? I mean, we've heard a lot. We've talked to LPs ourselves. They've talked about this idea of either wanting a quicker return of capital or wanting to see better returns than what was promised when they first entered into those ventures.
Yeah, I think, and I just got here last night, but apparently everyone's been talking about DPI, which is obviously how much capital you can return to your LPs. I think what the LPs want first and foremost today is more return of capital because they're mismatched in terms of how they want to be able to reallocate within their portfolios.
Yeah.
I don't know, our LPs are always tough on us to generate good returns. If we don't generate good returns, they'll fire us or they'll hire someone else.
Good stuff.
Well, can I squeeze one in?
Please.
Just about your existing portfolio there. I mean, I know you guys kind of rank those. You have that whole system. I think it was like 1 to 4 or something. Like when you talk about the quality of what you already have, are you comfortable with it?
Yeah, we've said this over and over here and over the last couple of months. Things from an economic perspective are better than we probably would have thought.
Yeah.
Defaults in loan and alternative credit portfolios are still materially below historical averages.
Yeah.
I get the question a lot of, do you expect they'll go up?
Yeah.
And if rates remain higher for longer, the answer is probably yes.
Okay.
So we're not forecasting, anything other than probably a traditional credit cycle. And that should lead to, I think, just dispersion of results. We think the really high quality firms with great origination and great risk management will continue to succeed, and the smaller folks who haven't been in the business quite as long could have a harder time.
All right, Kipp, we have to leave it there. We're going to try to get you to bump you to the front of the line for Magic Johnson here. Kipp DeVeer over Ares Credit Group.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Yesterday, a deal between PNC Financial Services Group and the TCW Group on partnering to deliver private credit solutions to middle market companies. Private credit, there's a lot going on, continues to be. Great to be talking again with Katie Koch. She's CEO of the global asset management firm TCW, which manages approximately $200 billion in client assets. You've been busy.
Thanks for having me on. Yes,
nice to have you. Tell us about this deal with PNC.
Yeah, sure. We're just by background. You mentioned TCW as a $200 billion global asset manager. We were an early entrant to private credit. That is led for us by the extraordinarily talented Rick Miller, our CIO of private credit. A 23-year track record in that asset class of conservative lending that's allowed us to outperform with a low loss ratio. And we're really proud to be partnering with PNC, which is, of course, one of the leading U.S. financial institutions. They're ranked 4th in middle market lending. They have an extraordinarily talented and tenured management team, a strong balance sheet, and great client relationships. And this has been a partnership, just to answer a question how it came about. It's actually 15 years in the making. So we've worked together very closely for a long period of time. Over that period, we've done 40 co-financings. And it is also true that they are our #1 fund finance partner, which means that actually PNC had to underwrite TCW and our capabilities in order to provide leverage to our funds. So this is a very, very strong partnership. And I wanted to just end, Carol, by saying that this is different than other partnerships that have been announced. And this strong relationship we have with each other has allowed us to create something really differentiated for 3 quick reasons. The first is that it's very middle market focused. So we're going to target loans to companies with about 15 to 75 billion of EBITDA. The second is that it's a shared investment approach. So we're both putting in investors to this partnership. We're going to work together on the underwriting and the origination. Of course, it will be shared by Rick, and that's because we have a shared credit culture of conservative lending that allows us to share the investment approach. And then finally, it's shared economics. We're targeting $2.5 billion of equity this year, and it will be strong contributions both from PNC and from TCW and our affiliates. So that economic alignment aligns our interests with PNC and also, of course, with our clients.
So, Katie, targeting $2.5 billion, how big could this partnership get, though?
We think this partnership could expand significantly over time, and that's important because private credit managers and banks, we think those partnerships with us and others will continue because banks are under some regulatory pressure, and private credit managers, they have the capital to allocate and to lend, and banks have great origination capabilities, and those two things are going to have to cooperate so we can continue to put credit out into the U.S. market.
What does significantly mean?
I'm not going to give you the exact billions of dollars, but I will say that
double from the initial 2.5 or many times?
Actually, for our credit alternative platform broadly, we've already doubled the AUM of that platform over the next couple of years, and we're expecting it to be many multiples over that. And this is going to play a very important role in the growth of TCW's alternative credit platform.
Carol mentioned at the start that you've been busy. Another, I guess, deal, if you will, was a conversion of 2 mutual funds to ETFs.
Yes.
In the AI space, talk a little bit about why you made that move.
Well, first of all, mutual funds in general, we think that they have a place, will continue to have a place in the market, very important part of our business.
It's still a big part of TCW.
Very big part of TCW, and will continue to be a relevant vehicle. It is also true that clients are looking at the exchange-traded fund vehicle because of the liquidity, the tax efficiency, and the transparency and ease of trading of those vehicles. And so we are going to convert several funds and launch new ETFs. We did one in AI. I do want to emphasize, I am a believer in generative AI. We have been managing AI strategies for 7 years. So this isn't something we just launched because ChatGPT is cool. We saw that transformative technology almost a decade ago and launched a strategy on that. We're investing in the technology enablers of AI and also the companies that will benefit.
That's what I'm curious is, what is a portfolio of AI stocks these days? Because if you ask someone else that question, they would just say, well, NVIDIA, maybe Microsoft, and that's it. I assume this is broader than that.
We have some of those in there. So these companies that are driving the technology of AI, but then also the companies that are the beneficiary. And it's actively managed, and it's relatively focused. And so what we're going to do is shift the shape of the portfolio as that narrative of AI changes over time. I do just want to say one thing, because I think it's important to be balanced on these issues. I do believe in the transformative potential of AI, but it is a story that's going to play out over the very long term. And so a vehicle like this is appropriate for people who can take that long horizon. And this is said a lot, but I think it's a very good reminder. The internet was also an incredibly transformational technology, but that didn't happen in year 1, in year 2, and year 3. It took 20 years. But if you stuck with that narrative for a couple of decades, and many of our clients have that type of durability of capital, it was one of the greatest wealth creation opportunities in the U.S. economy. And so we are excited about it, but balanced in telling people this is a great vehicle. Be active, be selective, which we are. Be with a manager that can evolve with the narrative, but also be long.
AI is such a part, as you know, of our investment narrative, just generally speaking. Take the big, broad macro, Katie. What are you seeing right now? How would you describe the environment?
I would say that we are long dispersion. The idea of dispersion across all of our portfolios. It's really hard to predict this in short increments, but what I would say to you, whether it's private credit or it's public credit, we think that the spreads, and I'm going to talk about public because it's just a little easier to point to valuations, which are at record tights in credit markets. In their post-global financial crisis history at record tights. That valuation is inconsistent with some of the obvious challenges that we have in this economy, regardless of whether or not we get a recession. Let's take the scenario where we muddle forward and have some type of soft landing, but rates we all believe will stay elevated because inflation's still pressure. That could create a credit event. Right, when rates are this high, and these companies were already starting to see stress in certain parts of the credit market, not priced into credit spreads. So in our liquid portfolios, Where we do take macro views, which is in the core plus space, remember that's people's retirement money. So we're managing that for their retirement assets over many decades. We're conservatively positioned. We're overweight agency MBS, which is carrying over the index, and we're being very patient. And eventually this is going to break. And when it does, we'll lean into those specific credit opportunities. If on the other hand, we do get the recession, then we're going to have a credit event anyway in both public or private markets, and that will create dispersion.
Are you suspicious that the default rate isn't something different than what it is today?
So this is a good point. Default rates are actually where we would expect them to be in the traditional levered loan market. They're low and actually went down in the first quarter in the private credit market. And I'm glad you asked that because we think that's really masking some serious liquidity challenges in the private credit market.
Yeah.
And the obvious question is why? Why is this happening? Well, I would ask first, why is there stress? The reason that we think there's actual stress that's not showing in default rates yet is because from 2019 to 22, these capital structures were highly levered with the view that rates would stay zero forever.
Right.
And that didn't happen. And now math's taken over and they're under pressure. Now, why haven't the defaults gone up? My answer to you on that is that if you look at last year, the amendments of these loans were 3 to 4 times normal. And we don't generally amend loans when things are going well. So this cannot be extended forever. And eventually those default rates will rise. I'm going to end with just bring it back to dispersion. If you look at the last 15 years in the private credit world, the dispersion between the top and bottom quartile manager is about 15 basis points. This is not high dispersion. That number could 10x or more over the next couple of years as these defaults rates rise. And that's why you obviously want to be with a manager like TCW that does conservative lending, diligence, very high levels of diligence, very significant underwriting. And we feel really great about how we're going to manage this environment for our clients.
All right, Katie, we have to leave it there. Great to talk to you.
Thank you so much.
Appreciate you taking time for us. Katie Koch, and of course, leads TCW, taking time to talk with us here on the Milken Stage.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we continue our special coverage here from the Beverly Hilton. And as the titans of private credit circle the hallways here of the Beverly Hilton, the legends of private equity, they want to remind you they haven't gone anywhere. And if anything, they've actually graduated, Carol Massar, to the next phase of growth. At least that's the view of our next guest, who says PE has now evolved into a, quote, form of business versus just its origins as a form of finance. And that actually lays a foundation potentially for better returns through building businesses and governance rather than just leverage and risk. Stephen Klinsky co-founded Goldman's original private equity group back in the 80s before branching out on his own in the late 1990s with New Mountain Capital. Pleased to say he joins us here. Definitely a legend in the business. Great to have you here, Steve.
Thank you both for having me here.
Let's talk about this idea of the evolution of PE and the idea of a form of business, because I hear this so much. This isn't about cutting checks anymore. Maybe it never was, but it's much more now about the hand-holding, about the business building.
Yeah, I'm one of the original private equity people around. As you said, I came in 1981 when the 10-year Treasury was 15.8%. There was lots of inflation, and it was about leverage in those years. 40 years later, there used to be 20 private equity firms. Now there are 5,000 private equity firms owning 30,000 companies, employing 12 million people. And the best private equity firms, you have all the advantages of being like a family business where you're close to the ground as shareholders, but all the scale of a big organization. You're not under 90-day reporting. You can get the best managers and build the businesses. So, the real success is it's not where interest rates 25 basis points higher or lower. It's how you took a company from good to great. And that's what we try to do, and that's what I think other good firms try to do.
What does that take, though? Or let me rephrase that. What are the companies themselves asking for from someone like a New Mountain or any of your competitors?
Yeah, we have mega fund strength, but we buy mid-market companies. So let's say it's a $500 million value business. The founder's retiring. He may never have done an acquisition, may never have gone global, may never have thought about AI, may never have thought about Salesforce construction. So we take businesses that are already safe and sound. We've never had a bankruptcy or miss an interest payment, but the key is building them up to a much, much higher level.
Never had a bankruptcy ever.
Never had a bankruptcy, never missed an interest payment. And we have now a team of 250 people at my firm and many, many more affiliated with the firm. So we can put in large sets of operators to assist the management at the company. And that's what it's about. You don't want to be good just in one interest rate environment and bad in another, or good one year and bad another year. It's all weather business building.
I love how you came out of the gate and started, because we keep saying, oh my gosh, we got to go back to like zero interest rates environment. That's the abnormal part of it. You come out of the gate and say 15, 16, 17%, talk to us about the constructive conversation we all need to be having about today's rate environment, what it means for the investment landscape.
Yeah, look, when at any given interest rate, private equity functions fine. As rates go up, things get cheaper, so it's easier to buy the new company, a little harder to sell what you bought before rates went up. So, but then it stabilizes. So when you actually go back to the early 80s, when interest rates were crazy high because of stagflation, that was the best time to buy companies because they were so cheap. And my firm actually had a very active year, both buying and selling last year. And I think we got some of the best things we've ever bought in the last 12 months when some other people were out of the market. So it's you're always buying and selling as a mature private equity fund.
Well, tell us about what you are buying or what's of interest at this point. I'm blown away that never, filing a bankruptcy. So what is kind of the secret special sauce, if you will, in terms of what you look for in a company and what you are, committing to? Yeah,
so what we do is we pick sectors proactively that are non-cyclical growth sectors, like life science applies, healthcare, IT. So, for example, years ago, we had a business called Avantor that started at $290 million. It's now worth about $20 billion. It's second biggest to Thermo Fisher and life science supplies. So a year ago, we did a big carve-out from Perkin Elmer, where we bought all of their life science supplies businesses, their legacy crown jewels and spectrometry and chromatography, and very complicated carve-out. They wanted certainty in a bad market, and I think we can add a lot of value to that company. Or we have a lot of good success with a company called Citrin Cooperman in accounting. We're in the process of buying Grant Thornton, which is one of the 7 largest accounting firms. Wonderful firm. We just bought BMI, which represents 1.4 million songwriters from Taylor Swift and everyone else. It's a business service that collects their royalties, and we think we can add a lot of technology and growth to improve it. So we're in these industries. My firm's now been around for about 24 years, so we've gotten stronger and stronger in these spaces, and we don't depend on debt, so we could just get some good buys.
Also, a common thread with a lot of those companies you mentioned is kind of the acyclical or non-cyclical nature of the businesses. So that is the core strategy.
It changes as the decades go on, but what sector can grow non-cyclically, high free cash, high barrier to entry for the next 5 to 10 years? That's where we focus. We have teams working in these sectors. And then when we find a nice, safe company, we then spend years building it to get the return. That's what we do.
All right. Steve, we're going to have to leave it there. Great to talk to you, and great to have his perspective here. Really one of the titans in private equity, Stephen Klinsky of New Mountain Capital.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, Citi CEO Jane Fraser was here at Milken. She expects the equity rally to continue. That was among her comments at Milken yesterday, appearing on a panel, a wide discussion on the market environment. Another member of her team also at Milken with us is Andy Sieg. He is head of wealth management over at Citigroup, and we're delighted to have him join us.
Hey, I'm great. Terrific to be here. As you said, there's a bullish sentiment here at the conference, so it's great to hear.
Are you see that among your wealth management clients? Give us an idea of the conversation.
We see people very front-footed in terms of looking for opportunities in the markets. Obviously, what's been happening in the U.S. market has attention around the world. Our business is very global. We see a lot of discussion, of course, about the U.S. election, but honestly, I don't think it's really driving investor decision-making. They're looking through that to just the underlying fundamental strength in the U.S. economy and value they see in our equity markets, even after this run.
Andy, get into some of the specific investments at the wealth management area that clients really are interested in. We talk about private credit. Here's another year at Milken. We talk a lot about private credit. AI is once again dominating the investment themes. I'm curious what those clients are asking for and what they want.
Well, you put your finger on it. I mean, probably the number one topic, and our clients in the private bank around the world are they're real change makers in the world. They're very high net worth individuals. They've got they're investors with great acumen. So the focus on alternative investments is at the top of their list. We happen to have one of the strongest alternative investment teams in the market, and so a lot of firms here at the conference are ones that we work with clients. In the U.S. equity market, healthcare is a topic that investors are very focused on.
What specifically in healthcare?
It's very broad based, because when you think about where AI and so many other technology trends are going to have their secondary and tertiary impact, it's going to be in an area like healthcare. So I think we're entering an era of innovation in healthcare, which is going to be mind-blowing. And investors see that, they understand it. We think it's a very durable trend and a place people are putting capital to work.
We have a guest later up coming up talking about innovation in healthcare.
We'll be talking exactly about that. I do want to ask you, though, I've heard you talk in the past about getting sort of a larger sort of wallet share, if you will, out of existing clients. What gets you there?
Well, I mean, hey, with our clients, as you said, Citi's business today, it's an outstanding business, but we've got a tremendous opportunity with our clients to do more with them. Mm-hmm. And so some of that is getting to know them more deeply, trying to connect the dots in situations where we're a corporate banker or an investment banker with a family office or otherwise a wealthy family, and introduce the investment capabilities of Citi. This is a powerful and broad-based investments business. It's not just alternatives. We were talking about earlier, we have some of the industry's most sophisticated capital market solutions. Right. We work with asset managers across the traditional space. And so a lot of this, honestly, is just ensuring that our dialogue is as broad-based as possible. We've got many clients who know us for our banking strength and our sophistication as a lender, and we're reintroducing them to what we can do in the investment.
But with regards to the wealth business, I mean, how do you sort of improve the performance? I mean, the last couple of quarters have disappointed to a certain extent, and I know that's just kind of the short term. But as you look long term here, what gives investors a more consistent return?
Well, I mean, from a shareholder perspective, I mean, this business, we've got a very strong focus on what the business model should be in wealth management. This should be a business with pre-tax margins approaching 30%, returns in the 20s, and strong organic growth. And so we're setting out in a very disciplined way to deliver that. First up, this business has to be more fit. We're taking a lot of topics that honestly are hobbies, and we're sunsetting those. We're readjusting the expense base in the business, and that's something investors are going to see, in this quarter. We're shifting the focus of the business, as to your earlier question around the investment solutions and investment advice we can offer to clients. Right. We can't just be our client's lender or their banker. We need to be their investment advisor. And we're elevating the quality of the experience that we offer clients around the world. Heavy investments in our digital platforms, focus on the training of our people and personnel, more discipline in terms of and intensity around how we cover clients. And we think that all adds up to a powerful proposition. And you're going to see us unify this business around the world in a way that ensures that regardless of where you're touching Citi, you have access to the best-in-class capabilities that this firm represents.
Well, there's a lot going on in wealth management, a lot of competition, too, out there, that's for sure.
Well, I mean, that's why the power of this brand and the strength of the client franchise, our challenge is different than most. We're not out trying to acquire clients first and foremost. We're trying to do more with our existing clients.
Makes sense. Andy, thank you so much.
Great
Andy
to be
Sieg,
here.
of course, of Citigroup.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
With the focus on investment banks, which have been signaling upswings in two business lines that don't usually take off at the same time, advising ambitious companies on expansions while helping others still drowning in debt. Now, those simultaneous waves of deal-making and restructurings, they've been the talk of earnings conference calls at firms like Evercore, like Moelis, as well as Lazard. Raymond McGuire knows more about this space than anyone, having run Citigroup's investment banking business for more than a decade. Before that, he helped run M&A over at Morgan Stanley, as well as other banking roles at First Boston, Wassertein Perella. And for the past year, he served as the president of Lazard, the world's largest independent investment bank. Ray McGuire joins us here on the Milken stage. Great to have you here. You have a pretty long resume.
I'm with you guys. This is big time.
Is business good right now in the investment banking world? Is it better?
You know, we just announced first quarter record earnings in the first quarter of this year. So the answer is yes, business is good, and I say that with cautious optimism. There's still headwinds out there, but we think the tailwinds are pretty strong, and so we'll see how this evolves. And you're right to point out that we have both a restructuring business and an M&A business, which historically have not worked so much at the same time. But today we see that it's a little different.
Is the economic backdrop supportive of that? Is it good or good enough?
I would look about the economic backdrop is, look at it where Fed rates are today. We think that's going to be higher for longer. With the corporates, that translates into making certain that they got the right strategic profile and the right strategy. For the asset managers, which are 30 to 40% of the overall fee wallet, we're figuring out what they're going to do, right? Many of them are active. Restructuring, as you said, is an active part of the business, and we expect for both to continue.
Ray, it's fascinating to hear you say record quarter, and then you're like cautious optimism. That's kind of a span. Why? Why are you so cautious in this environment? Because
you still have some tailwinds out there. Some headwinds out there. So what
most? What most?
Well, interest rates being one.
Yeah.
The interest rate, what's in front of us today are interest rates and the state of the economy. Inflation remains sticky. The Fed is looking closely at the data. That's what's in front of us that we have to manage. What's ahead of us is what's taking place geoeconomically and geopolitically. And there I'm looking at 5 different trends that we need to manage. AI is one, energy transition another, deglobalization or reshoring is another, what takes place with cybersecurity is another, and then what takes place with aging. The largest growing part of the American demographic is 65 and over. Mm-hmm. And if you look at the American story as the kind of the anchor to the global north, and then you look at the global south where the largest growing population is 30 and below. So we have to take all those factors into consideration as you think about the trends that are taking place. And I'm distinguishing between a trend and between a cycle.
That's a lot. That's certainly a full plate, right? And so I get the cautious optimism. Is it something that as we kind of deal with all of those and some of the disconnections we might see play out in the marketplace, does it ultimately lead us to some downturn at some point to kind of find our way through it?
I can't see downturn. Okay. I can't tell you that the headwinds are that strong. The tailwinds are probably a little stronger than the headwinds, but they exist. So I can't predict a downturn at all. I'm looking at where the market has traded. The S&P for the past 15 years is now traded at, one of its historic highs for the past 20, 50, 100 years at close to 14%. The dollar is the strongest it has been in 15 years. I look at that and I look at what's going to take place cross-border as an example. The North American wallet still remains the largest. Notwithstanding some of the headwinds, I think the tailwinds are pretty constructive as well.
Do you think you have a good read, though, on the economy? I was listening to the panel. You were on a Milken panel earlier today, and I was listening to some of the comments, not only that you made, but some of your colleagues made, about the state of the U.S. economy specifically, and how what we're seeing in the data doesn't necessarily reflect the true pain that we're seeing on the ground. How much does that matter, that there is a disconnect between some of that top-line data and maybe what's happening on Main Street?
The markets have been able to perform notwithstanding what we see with inflation. Mm-hmm. And I've just cited to you what's taken place over the past 15 years. If you look over the past 5 years, you're going to see commensurate data that suggests that at least the markets are performing. There's clearly some volatility to them. If you look at the VIX index, up and down, not as high as it's been during the great financial crisis, but, it's up and down. We need to pay particular attention, as I think the Fed is doing, at what's taking place on Main Street, which is inflation, which is the value of the price of a carton of milk or a dozen eggs.
It's real.
That's real, so we can't ignore that. And as you think about how you manage a portfolio of assets, either corporate assets or assets that exist in the asset management world, you got to be mindful of that. You got to be mindful of the implications on valuations, if you will. And we don't see that togetherness yet, at least with some of the asset managers.
Well, that's interesting that you say that about valuations. All right, so I don't know, when you look at deal activity over the next 6 to 12 months, what are you anticipating?
You know, we have pretty good momentum today, but volatile. So our expectations that you're going to continue to see strategics. They need to grow. They need to remain competitive. And if you see a lot of the activities taking place by the strategics, it included mergers and acquisitions, stock transactions. And the cost of financing is pretty high, and I don't think the market has actually digested that from the standpoint of using cash or borrowing capacity as currency because the rates are so high. We are seeing a lot of the currency being used there as stock. You can benefit from that. It's an appreciation, the value of the combination, plus the benefit from synergies.
All right, a colleague of mine, you got 20 seconds. Are you going to run for mayor again?
Oh, gosh, you went there.
I am quite confident with where I am. And, you know, my objective today is to do whatever I can to add value to Lazard and the Lazard shareholders and be a partner with Peter as we've set the strategy out. Now, our objective is to go execute.
All right, well, that was a good way to go. And she stole my last question, which was going to be about not about being mayor, but about his involvement at Studio Museum of Harlem, chair of Studio Museum of Harlem, and the Whitney. I want to talk about arts with him, but she took it away from me. Ray McGuire, guys, president of Lazard.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Now, at the beginning of the year, our next guest said there's more pain coming for commercial real estate as the unwinding of years of easy money begins taking its toll on the sector. He is Victor Khosla, the founder and chief investment officer of distressed debt specialist Strategic Value Partners. They are an $8 billion global alternative investment firm focused on distressed and deep value opportunities. Joining us right here at Milken. How are you?
Very well, thanks. Thanks for having me.
Well, it's great to have you back. So distressed, how distressed are some of the assets that are out there?
You know, we are today, it looks like a wonderfully sedate world, right? High yield spreads, 350 basis points, technology, equity stocks are up, right?
Yeah. So everything's awesome?
On the face of it, it's like ducks.
Ducks gliding in water.
Yeah. It's
their legs are just like spinning around.
Yeah. It's, you know, so what people miss a little bit, there's $4 trillion of private equity assets invested in the ground. There's $5 trillion of people they have borrowed to make. And where we are today, high interest rates, a sluggish economy outside tech, Europe near recessionary, a wall of maturities over the next 3-4 years. So I think what you miss is, oh boy, there's a slog now to kind of work through this.
All right, so when does, and I'm looking at our live blog here on the Milken Conference, and that's one of the things that they highlighted, that you see the companies hitting that debt maturity wall. So when does it start to come undone?
It started. So, you know, when you look at what we do, if you use us as an example, right? Starting about 12 months ago, we started to speed up the pace of investing. Right? So this is not like it's coming next year or something, because what happens is the maturity wall today is there's very little in 2024. In 2025, 26, 27 is $600-700 billion a year. $600-700 billion a year, and you've got to address it early.
Right.
So the maturity wall, people are addressing it. It started.
But you've seen some of the creative tactics now that we're starting to see some funds take to make sure that we don't see those defaults.
Right.
Whether it's doing selling to another fund, just peeling off a stake here and there. I wonder, like, what do you make of that in terms of the sustainability of that strategy and protecting those companies until, in theory, we get to the other side of whatever we're going through?
And it is, you know, private equity investors are really smart, and they wiggle.
Yeah.
Right? They're wiggling. But I think when we look at that world, how big it is, our view, there's $500 billion of what we would call adventurous financing, which is required, which will be there. They'll push it off, but they'll pay a pretty price for pushing it off, right? And there's 300 billion or so we estimate, which is going to be just like I give up.
And just to be clear, the values we're talking about too, those have been inflated because of some of these new agreements and some of these new extensions.
Yeah.
But it gets to the question though, do we need, say, like a recession or some real huge economic shock to shake this out? If not, if we don't get that shock, you think this will still play out in your favor?
Our view would be we don't really expect some headline-grabbing recession. There is a chance. There is tail risk in this economy. Our base case in the United States is it's a little bit of a slog.
Yeah.
And so we're not expecting, oh my gosh, there's a credit market crash or anything like this. But just to deal with what we have, for somebody like us, we've got a broad set of skills, right? We don't just buy debt at 50 cents. We have the operating skills to fix it, to take control of a company, to manage it better. For somebody, when we buy assets, we own operating platforms to own the asset and to fix it. Yeah. For somebody like us, it's really attractive.
Would you want to own commercial real estate assets though right now?
We've been looking, the most interesting investment we probably made in commercial real estate, one of the two best investments we've ever made in a firm was in commercial real estate 2-3 years ago, right? But what I would tell you is last 10 months, we are seeing that slide. We are in the process of making our first ones, but boy, you've got to be careful. Yeah. When you look at these office properties, there's $2 trillion of office mortgage debt in the US and Europe. But you don't know, is the occupancy, hey, it's 40%, how much money does it take? Yeah. You've got a problem, you've got to be careful.
You got to do your homework, that's for sure.
All right, Victor, we're going to have to leave it there. Victor Khosla over at SVP. And it gets to this idea, too, of where those opportunities are. And we talk about both sides of the equation, the folks that might be forced to sell, but more importantly, the folks who are there to buy.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's talk about capital. It is homegrown right here in Los Angeles. And it's probably best known for its prowess in picking stocks. But as of late, it's been putting up some of the best results among actively run bond funds. As of last year, a manager of $2.5 trillion in assets had amassed almost $500 billion in fixed income holdings. That's more than double what they were less than a decade ago. It's elbowed its way past fixed income rivals who are still enduring a siege from cheaper index funds and rising interest rates. Here to talk about the state of the market is Mike Gitlin. He is the president and chief executive officer over at Capital Group. Great to have you here, Mike.
Good to see you again, Romaine.
Let's start talking about the bond side of the equation. We'll get to stocks in a second here. And talk about the evolution of it, because the growth there has really picked up in recent years. What was behind that?
What was behind that really was investment results. Our team tried to generate a predictable pattern of returns. We have a really strong team. They were able to do that over 1, 3, 5, 10 years. And clients appreciated that journey. Clients in the bond market, they don't want a wild ride. And the team was able to generate those kinds of outcomes, and the assets followed.
Your team was working with financial advisors to push this as well. You had new products, ETF products too, right? If I'm correct?
We launched a bunch of new investment services, mutual funds, ETFs, collective investment trusts, whatever the vehicle of choice for the client was, institutional separate accounts. But the real difference was beating benchmarks after fees. If you look over 5 and 10-year periods, 100% of our bond strategies beat the benchmarks net of fees. That's a good story to tell for our clients.
The fixed income environment today, is it, Mike, a once-in-a-generation event in your view?
I don't know if it's a once-in-a-generation event. There's a real opportunity, though. If you look at the bond markets right now, you can generate anywhere between 5 to 7% yield without taking a tremendous amount of either interest rate risk or credit risk. That's a heck of a lot different than it was 5 and 10 years ago when we had zero interest rate policy. So we see a lot of interest in the bond markets. Even year to date, we have about $1 billion of net new flows per week into our strategies. I actually think that's going to accelerate once we get the first Fed cut and people can get real income. In the previous decade, the income wasn't in fixed income.
Yeah.
Now it is again, and there's a lot of opportunity.
Did you think we're going to get that first Fed cut, though, soon, this year?
Look, I think we're looking for the inflection point, not the month. I think later this year we'll get our first cut.
Okay.
And I think that's where you have to lean in and start being comfortable owning duration again in bond strategies. What hurt clients in 2022 was owning duration because rates went up so fast.
Yeah.
It works the other way around too. So as rates get cut, clients are going to benefit not just from income, but from total return by owning duration. So as we get that first rate cut, there's going to be a lot of opportunity in bonds. And also cash as an instrument, cash is going to decay in value once you start getting rate cuts. That's just around the corner.
How much are you still seeing in cash right now?
So right now, globally, there's literally $10 trillion in money funds. The baseline for that is about $3 trillion. So there's about $7 trillion of excess cash sitting on the sidelines. That cash will come into the bond market before it runs into growth equities. So that's what we're already starting to see, that kind of flow. And again, I think that will accelerate as you get to the end of this year and into 25.
Well, explain that why you think that. Why it will flow more into fixed income rather than into growth equities?
You know, if you've been hanging on to cash and you've been comfortable getting 5%, you don't necessarily leap directly from cash into more risky assets. You tend to take a little stopover in fixed income where you're generating better return than cash, but on a risk-adjusted basis in a little bit more calmer environment. So I think it will stop there. Ultimately, we'll see equity flows, and we're beginning to see some of those as well. But I think you'll see the first stop into the bond market.
But with all that money that's sitting in money market accounts, cash accounts right now, that level that you cited, 10 trillion globally, whatever it is here in the U.S., it's been at that level now for a while. So, I mean, it's got to be more than just a Fed cut that sort of shakes that up and gets that money out.
You know, it's market volatility, it's concern about elections, it's concern about geopolitics. All of those things, when you're getting paid 5%, may convince you to sit on the sideline.
Right.
Why not? And that's what some people are saying. The reality, though, is once you start getting these Fed cuts, that 5.25 cash yield goes to 4.75 and 4.50 and 4.25, and at the same time, you have this opportunity to generate better income and total return in active bonds.
One last question, just quickly. You said money is starting to go into the equity side, all that cash that's sitting on the sidelines. Where in equity is it going?
You know, in equities, we're going to see a broadening beyond a very narrow benchmark in the S&P 500. You're going to see a broadening into small and mid caps, into dividends, into international stocks where MSCI X, the U.S., over the last 15 years has done half as well as the S&P 500. There's a lot of opportunities outside the U.S. So I think you'll see that spread around in a lot of different areas.
So when we talk to you a year from now, we're going to be talking about the full-on embrace here.
Got the full-on,
everything.
Of the equity universe?
Equities and long duration, everything.
Out of cash, too much money in cash.
Yeah, all right. Mike, we got to leave it there. Great to talk to you. Thanks for taking time for us. Mike Gitlin, who leads the Capital Group. And I always like to talk to folks, you know, these are like the homegrown companies too here in LA. So I'm always into that stuff as well.
And it's kind of fascinating, all of the kind of alt investment strategies, private credit that we've talking to, just kind of really get a good view in terms of what's going on in fixed income and also a little bit in the equity side.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The annual Milken Global Conference is dominated by leaders in finance. You know that. Another category that always factors into the speakers and conversations is health and wellness. Our next guest here at Milken was featured recently in a 60 Minutes piece on the work he is doing at the Rockefeller Institute at West Virginia University. We welcome neurosurgeon Dr. Ali Rezai. He is the Associate Dean of Neuroscience at West Virginia University. He's also Executive Chair and Director of the Rockefeller Neuroscience Institute. So nice to have you here with Romaine and myself. I have to say, when we were planning for Milken and your name came up, I'm like, yes. 60 Minutes did recently feature some of the work you've been doing, but you've been studying the brain, neuroscience, neurology for a long time, many decades. How much have we learned about the brain and its connection to maybe future healthcare treatments? How much more do we have to learn?
So neurological conditions are growing as the population is aging, and we have more people with Alzheimer's disease, more addiction, people with ALS, people with different types of dementias. And we need to find solutions, and we need to work together between industry, public, private sector. In the same way we came up with the solution for COVID, with the COVID vaccine, we need to build teams together that are accelerating the pace of discovery, because Alzheimer's is not going away, addiction is not going away, and we need to find solutions quickly.
Well, the pharmaceutical industry is really trying to find solutions for Alzheimer's. You have figured out something, and also with addiction, and it's using, I'm going to be very basic, but sonograms. So talk to us a little bit about the work you were doing.
So we're using ultrasound technology, and this has been universally there when you look at a baby in a womb.
Ultrasound, I should say, yeah.
Exactly. So it's one ultrasound looks at a baby in a womb, or for heart doing echocardiography. In this case, we have 1,000 ultrasound probes that we're delivering the energy that goes through your hair, through your scalp, to different parts of the brain, and converging in different parts to stop the tremor from Parkinson's, to open the blood-brain barrier so more drugs can get into the problem area, or to reset parts of the brain involved with substance use disorder and addiction. So the application...
Which hasn't been happening before with Alzheimer's, right? Because the drugs, they don't penetrate quickly enough.
Exactly. So we have good pharmaceuticals industry is doing a great job in accelerating discovery, so drugs are able to go in, but 99% of the drugs have difficulty crossing a blood-brain barrier, which is in your brain's blood vessels, and that's why you have to give higher doses, more frequency, and long-term drugs. But what if now we can open the blood-brain barrier non-invasively with an outpatient procedure temporarily, to allow much more drugs to get into the area where the problem is. And that can potentially help really accelerate and make drugs even more effective and safer.
How close are we to that, to seeing that actually deployed?
We and other groups have demonstrated that, where we can non-invasively, for example, somebody with Alzheimer's, they have these protein buildup in the brain. So we can open the blood-brain barrier in the areas with beta amyloid plaques and then deliver the antibody. So now the antibody can get in faster because the barrier is open, and then do its job. So we found that in an initial study that we can increase the removal of these plaques by 53% more as compared to antibody alone.
Is that going to be effective on people who are in advanced stages of Alzheimer's, or is this only going to work on people who are maybe at the early stages?
Right now, studies for very early stage, but this has potential for Parkinson's, for people with frontotemporal dementias, ALS, and many other conditions. So we think this is important for the pharmaceutical industry and partnership to now provide a new way where we can deliver the drugs to the brain, to the problem area exactly where it is, deliver the payload, and then it closes, so the drugs can become more safe and more effective potentially.
Dr. Rezai, Alzheimer's is one thing, addiction is another one, and we probably all know someone who's had to deal with addiction on some level. Tell us about the same kind of treatment, similar, or I should say, that's also being effective when it comes to addiction.
Yes, so the same technology is being used. There's a part of your brain, deep in the brain, that is your addiction center, reward center. So this country is having a big problem with substance use disorders, fentanyl, heroin, cocaine, meth, and there are more than 40 million people with substance use disorders. So the solutions can be effective, but they're not good enough. Last year, sadly, 110,000 people died from overdoses, and it's only getting worse. So we need to explore new technologies and partnership with science and industry to help people with addiction. And the work that we did, we're able to show initially that we can deliver the ultrasound beam and reset the brain, the craving parts of the brain, so the cravings are dramatically reduced, and people are now able to deal with addiction and the cravings better, and are not taking as much drugs. So we're very excited about this opportunity.
I do think about here at Milken, right, it's all about capital, lots of money here, investing, going to different places, capital flows and medicine and treatments and discovery.
Yes.
Tell us what you are seeing on that front and what more you would like to see.
So what I discussed with you about Alzheimer's work and the addiction, it was all developed by philanthropy and foundations giving us the seed capital. And that seed capital raises all the other sectors coming in. And it's only with combining philanthropy with science and technical expertise, industry, government all together. Once they come together, magic can happen. And we've already shown that for COVID, for example, with the COVID vaccine. And this needs to also happen for neurological conditions, because many of them we don't have a solution for. Population is getting older, and we have people that we need to help. So we should be very impatient and try to collaborate together to help people find cures and also find ways to improve the quality of life.
With the money that's being raised, particularly the money that's not coming from, say, philanthropic organizations here, obviously there's a demand of return at some point here. What exactly are those folks asking for?
So once we do the initial work, this is all technology that leads to new innovations that can build new businesses. Mm-hmm. So you can find new businesses. There are dozens of companies making ultrasound systems. Combination therapy will enable the pharmaceutical industry to have better solutions to deliver the drug to the exact area. So you may not need years of treatment, you may need just a few treatments. So this actually will accelerate discovery and innovation and will lead to more technology commercialization opportunities.
I have to ask you, as someone who's had to watch firsthand on a couple of occasions, people dealing with dementia, Parkinson's, and the very slow process of watching that unfold, we've seen sort of these potential breakthroughs that promise that this would be the last generation of folks to really suffer from this. And we've seen that come up short. How do we make sure that we don't run into that again?
Right now, we're having some good solutions that help people improve their quality of life. We need to search for the cure, but only, in my opinion, by bringing teams together with a passion and purpose and an impatience and a sense of urgency, because you're right, Alzheimer's is not going away, Parkinson's is not going away. So we need to bring in more capital from foundations, from philanthropy. We need more collaboration with the industry and the private sector. We need government collaboration. And fundamentally, it's about patient suffering. We need patient advocacy groups. Once that all comes together, we can provide new solutions. We may not have the answer, but we're going to give it our best shot and help quality of life and seek for cures.
How do you think about, and kind of going back to where I started, I think there's so much we've learned about the brain, so much we still are learning. I mean, when you think about innovation in healthcare, what will be kind of the next frontier? Here we are talking about the diet drugs that seem to be fixing everything that ails us. But how do you think about it, the smart frontier going forward?
I think for the brain, we need to understand diagnostics, detect Alzheimer's earlier, because Alzheimer's and Parkinson's, for 20 years, your brain is degenerating. You're not aware of it. But what if you can detect it 10 years before you first have the first manifestation of it, or to be able to treat people better than ever before? So number one, detect it earlier, change lifestyles or participate in clinical trials, and have new solutions. This technology like the ultrasound. It's used for looking at a baby or the heart, but now it's used to treat brain conditions. So embrace it, partner, and then we can accelerate the pace of discovery and do rapid cycle innovation. So I think the future is bright, but we need more partnership and collaboration here.
All right. Well, listen, so delighted to get some time with you. Really appreciate it. Dr. Ali Rezai, he is, of course, at the Rockefeller Neuroscience Institute. He's the director of that at WVU. Interesting, right?
Yeah, and I think, needless to say, everybody is rooting for him, even if they don't know him. This is something that I think has plagued so many families, and everyone really is holding out hope that we finally see that. And I like what he said, too. It's not just about what the scientists are doing. You need government buy-in, you need the philanthropic organizations, and you need the private sector, and that helps push this along. You saw what we were able to do with COVID.
Well, that's what I was thinking. During the pandemic, what we were able to do so quickly, but everybody came together. And this is what's kind of interesting about Milken. We're going to be back tomorrow. We've got more interviews, but it really is this cross-section of, yes, finance, but it's healthcare, it's wellness, it's everything that's kind of going on in society, and how do we find the money that's needed to find the right solutions going forward? Yeah,
well, maybe we'll hear some of that tomorrow.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.